Hi, this is Ben Tafoya. I'm back with another 5 o'clock macro episode. It's today, Saturday. I took Friday night off, but I have some things to say today on April 25th. Um, and we've been talking about uh, the uh, the idea of economic growth and what helps economies grow. Um, I said, hey, if we want to make the economy grow, we just have to add C plus I plus G or X sub M. But then I talked a bit about um, the differences or issues with respect to just sort of wishing that into activity. And I went back to an old model of economic growth that talked about the factors of production in society and how we work to improve those factors either in quantity or quality, and that those structural changes that can help improve economic performance generally take place over time. It takes a while to um, make things happen in that way, and that sometimes there's government action that we need to fill a hole in demand, and we'll talk about that soon in terms of fiscal policy and monetary policy. Government can boost government spending. Most governments can, not all. And the government can also increase the amount of disposable income people have. So there are various tools at government's disposals. And one thing we should be aware of, and I talked a bit last time about the different ways that workers are treated in different kinds of economies, and how you could reorient some policies to make folks more productive and have a higher quality of life. But fundamentally, all market economies are a bit different. Every society makes different decisions about what they want to include in the government sector, public sector of their economy, and what they want to include in the private sector. Here in the United States, for instance, our healthcare system is famously divided roughly 50-50 between public health care of some form or another and private health insurance. And there are other aspects of that trade-off. In the United States, most students who attend institutions of higher education in the U.S. do it through public higher education. Others do it through private, whereas in other countries the ratio is much greater, public to private, than it is here in the U.S. And so you see a significant difference, and the OECD shows some of this. They have statistics that they show related to the amount of government spending. So you can see here, here's the U.S. on the continuum. Government spending represents 37.9% of GDP. This is all in government spending, federal, state, local, etc. There are some countries with lower percentages of government spending, such as Ireland at 28.9. But you'll see that there are many high-income countries that have a much higher percentage of government spending as a percentage of their economy. So you get somebody like Finland at 56.5, France at 56.8, and Denmark at 54.5. And that is an indication of the difference in the way that societies allocate goods and services between their public and their private sectors. But for the remainder of the segment tonight, I wanted to talk about money and why do we have money in the modern economy. There are three basic functions of money in the modern economy. One is it's a means of exchange, meaning that it's much easier to break a $10 bill when you're buying a loaf of bread than it would be to have to trade uh, through barter, like apples for bread, or to have to shave off some gold from a gold bar that you're holding on. So um, many centuries ago now, we actually developed money as a means of exchange for transactions. Transactions could involve the sale of your labor, it could involve the sale of goods or purchase of goods, what have you. But money's one of its most important functions is that as this means of exchange. Money is also a store of value. I go to buy a house, and the house is valued at $500,000. That's the value of the house in terms of money, and that there'd be some sort of relationship between that and the value in the market and the sort of imputed income stream from ownership of the asset. But fundamentally, that all adds up to the dollar value as a store of value. And finally, it's a measure of monetary worth. So when we say that somebody like Jeff Bezos has a worth of whatever it is, $150 billion or whatever it is today, that's measured in money to give us a relative sense of the difference between what we're worth and what Jeff Bezos is worth. Money is that kind of measurement tool. And what is money? Well, we certainly understand money to be currency. And in the United States, we actually have two technical definitions of money. One is what's called M1. It's closely monitored by our financial officials between the Treasury Department, Federal Reserve, etc. And M1 is currency in circulation plus checking deposits. And the graphic here shows M1 as this red line towards the bottom, just so that you can see the relationship between M1 and what we call M2, which is M1 plus near monies, such as savings accounts, money market accounts, etc. So M1 is stuff that you have access to immediately that you can use for spending. It's currency, and typically there's a ratio in the United States of something like 10 to 1 between M2 and the currency component of M1. The rest of that balance is made up by the checking deposits. But you can see here this blue line at the top is M2. It's the amount of money that is on deposit with banks and other financial institutions, plus the currency that's in our pocket. And you'll notice that there's a pretty decent sized bump in 2020 here for both M1 and particularly M2. And we're going to talk about that bump in coming episodes as we talk about what the Federal Reserve does and how it has an impact on the economy. So how do we manage money? Well, money's managed by financial institutions, and banks and the other financial institutions. Theoretically, in the market economy, we need efficient intermediaries. We need some mechanism for us to be able to save our money, get a return on that savings, and for other folks to be able to borrow it. So basically what banks do is they borrow money from depositors, households and firms and government, all of those sectors put money on deposit with banks. And then they lend money to borrowers, again, households and firms and government. So our checking account deposits that come in from our paycheck, that is money that's held by the banks and then used to provide loans to people for things like home mortgages or automobile purchases or credit card transactions or whatever. Banks are that intermediary then between the depositors and the borrowers. And when we think about it that way, we figure out that it is kind of a boring business model. And that business model is supposed to function this way. And there's a difficult constraint here, which is that when you think about it, the money that banks get on deposit from households and firms and government, by and large, those entities can withdraw that money anytime that they desire. So their banks are receiving money in on a short-term basis. The Federal Reserve rules that we'll talk about indicate how much of that has to be held back, but they can lend most all of that money back out to households and firms and government who want to borrow it, and they may want to borrow it for significant lengths of time. So a home mortgage could be 30 years, could be 20 years, 15 years, whatever it is. It's longer than the amount of time that we depositors have to keep money on loan to the banks. So the banks are trying to manage that risk. They're trying to manage that cash flow. And as we saw in that period of the Great Recession from 2007 to 2009, when the banks and other financial institutions don't function properly, they can cause problems for the real economy. And that's why we have a system of bank regulation. And it's also why we take steps, as we took some small steps after the financial crisis, to add regulation to the behavior of banks. So our banks are regulated in the U.S. by a complex set of regulators that include the Federal Reserve, which plays a critical role, but also from our perspective as depositors, one of the most important one is the FDIC, the Federal Deposit Insurance Corporation. That's an entity that the government created to basically be an insurance fund for depositors so that their money is there when they need it, regardless of the financial health of the individual banks. So the FDIC guarantees the amount of your deposits. Typically, it's up to $250,000. Sometimes, in extraordinary times, it'll be more than that. And the FDIC plays a significant watchdog role over banks to keep an eye on when banks may be failing and why. There are also state banking regulators. So states have some oversight related to banks. And then there's another complex set of federal regulators. It was simplified a little bit in the Dodd-Frank bill that was passed in 2009, 2010. But it's still pretty intense. And we'll talk next time much more about the Federal Reserve and the role it plays. And so just one 15-minute segment today. But on the way out, I wanted to treat you to some ABBA.